Stephen, great to see you. Let's first of all talk to you about these asset bubbles here, and how are they likely to play out on the foreign exchanges?
Well, yes, I think it's one of the key issues for 2010. Clearly, what's occurring is that the monetary policy that's appropriate for the US is now very different from the monetary policy that's appropriate for many of the nations that are pegging or pseudo-pegging their currency to the US dollar. And that tension is only going to arise or increase through the course of next year. The way to handle it for central banks in the emerging markets is to obviously accelerate reserve accumulation, but that brings with it its own problems, not least the fact that it displaces dollar selling pressure from against emerging markets onto euro dollar, and that's of course why euro dollar is above 150 today.
Do you think that any of the efforts that some central banks in emerging markets are making to try and cool the inflows can actually be successful?
I would imagine they're more a policy that's going to buy time rather than bring ultimate success. I think the rash of unconventional policy measures we've seen across emerging markets, Brazil, South Korea, Indonesia, etc., in isolation, meaningless, but together, meaningful. I think it's a policy response to rapid reserve accumulation, and it's a sign that central banks in those regions are becoming a little bit uncomfortable with the status quo.
But the message they're sending to investors is don't invest too much in our, in our currencies and our securities. But as long as the conditions remain as they are and rates stay low in the Western world, you would imagine that you'll still see money flowing towards these currencies.
Absolutely. If you have a relatively stable exchange rate, or a completely stable exchange rate in the case of China, and you have an economy that's generating a weighted average return of, say, 10%, i.e. in line with nominal GDP growth in China, and you have investors in the West able to fund near zero, then you're going to see a torrent of capital flooding into emerging markets, and it's how that is reconciled that's absolutely pivotal for foreign exchange going forward.
Steve, just want to get a general question on what's happening with the foreign exchanges at the moment. We've seen this breach of, what, 86, 87 yen for the dollar, also 150 against the euro. Does it just get worse here for the dollar? I mean, does it continue to weaken?
I think over the near term, yes. Two particular dollar negatives out there at the moment. Obviously, the Federal Reserve maintains a relatively dovish stance, and so interest rate differentials are certainly seeing the dollar underperform within the funding currency group, which includes the Swiss franc and the yen. More broadly, as we've discussed, the regime of inflexible exchange rates in emerging markets continues. The flood of capital into emerging markets continues. Reserve accumulation and reserve diversification buying of euros continues. And until that system breaks, then the euro is going to be under upward pressure. I wouldn't expect a turn in this until the early part of next year.
I mean, I was looking at the foreign exchanges earlier, and the Swissy very much at the core of things this morning. Yes. And what we did see was this breach of parity for the franc there. But now, moving up the dollar against it, what are you hearing from the Swiss National Bank, if anything?
Not a great deal. Obviously, realised volatility in Euro Swiss, which is obviously...
Are they in there at the moment, though, Steve?
I'm not aware of that, and I wouldn't be able to comment, to be honest. But realised volatility in Euro Swiss has obviously collapsed, and I think that's the effect that the SNB were looking for. And it's really Euro Swiss that we need to be looking at, because that really dominates the Swiss trade-weighted index.
Right. What's your trade of the day, then, with all that in mind?
My trade of the day, I think, to continue to play dollar yen from the downside. I think the rate differential supports that, and the general negative dollar environment supports that.